Good morning, everybody. It is Friday, May 7th, 2021. Let's talk about deflation, inflation, unemployment, Fed policy, the effect on stocks, self-driving cars, and making fun of Elon Musk, and Bitcoin, and Dogecoin, Doggy Coin. All right, first of all, I first published this at Margin of Safety Investing, long-term deflation versus inflationary policy. It is also at Fundamental Trends. And just to give you a quick primer again, if you are not a member of Fundamental Trends and you'd like to be, you can get a free library card, give you access to the macro and a lot of the free stuff. And then you can follow along with browser alerts, choose profits, not crash, then allow. You can do the same thing here or down here. And now we take a look at an idea. Demographic deflation versus inflationary policy. That's what I called it here. You can follow this if you like. If you can't solve these equations, you should probably not be investing your own money. When you get to the end of an article or after you've been on the page for about a half a minute, you can follow and actually get the articles emailed to you as I publish them. So all sorts of ways to get the articles now. And everything that is at Margin of Safety or on Seeking Alpha is also on Fundamental Trends. You may have to pay for some of it. All the free stuff on Seeking Alpha will be free at Fundamental Trends behind the free library card. Now, let's take a look at this article. 44 comments since late yesterday afternoon. Just going to give you the summary. Long-term deflation is being driven by aging demographics, massive debt, and disinflationary technology. I penned the term slow growth forever about a decade ago on MarketWatch as a way to describe the baby boomer bust. During the past decade, really only central bank monetary stimulus and government fiscal stimulus has been able to prevent a deflationary spiral and the corresponding financial distress that would entail. Counter-cyclical policy, and I've talked about this 100 times at least, has been designed to fight deflation. And historically, because everything was in a long-term uptrend, any downturn was seen as temporary, and therefore you could spend your way out of it. Today, the long-term downturn is not really temporary. We no longer have a long-term huge uptrend that we had from the post-World War II period until the very early 2000s or around 2000. Why? It has to do with demographics, and I'll show you some charts here in just a second. The consequences of inflationary policy into long-term deflation has been inflated asset prices and increasingly dangerous imbalances in finance across the board, in addition to huge wealth inequality. So the investor class is basically making all the money, and the other 80% of the people make nothing. And really, about 1% of the population makes 70, 80% of the gains, with the next 20, 30% falling to the rest of us in that investor class. And 80% of the people really aren't investors. You know, they might have a little retirement plan at work, but 80% of people don't save any money. So 4 out of 5 people aren't really saving and investing money. Now, that has certainly started to change with the millennials, but it isn't dramatically different. It's enough at the margins to manipulate certain stock prices from time to time or cryptocurrencies. We're going to finish with cryptocurrencies today, because I think it's very important to consider the implications to the rest of the market. So demographics is destiny. And in the United States, the population is getting older, which means more people spending less money as they age. Globally, your 4 biggest economies, China, United States, the EU, and Japan, 4 of the 5 biggest economies. I guess India has passed Japan now, and it would make sense since they have 1 billion more people. But 4 of the 5 biggest economies of the global economy have huge demographic problems. This is the spending curve over our lifetime. As we get older, we spend more. By middle age, we're buying that second house, the third car, and sending a kid to college. That's where our spending peaks, big vacations. And then as the houses get paid for, kids move out of the house, they get their own jobs, and now they're here on the cycle. Our spending starts to come down until, of course, that last year of life where we spend a wad on healthcare. So from post-World War II to around 2000, baby boomers for 3 decades after the World War II rebuild drove the economy. And if you know much about the stock market, when did we have a very long-term bear market? From the late 60s to late 70s, right? So we had about a 12-year bear market, and that coincided with fall off from the World War II rebuild until the time that the baby boomers really started getting into the market. Labor market, housing market, car market, all those markets, stock market. And they drove the economy up. Got to their peak spending years around 2000, right? Got the last big house they're going to buy. Many are now starting to downsize 20 years later. And we had 2 pretty horrific stock market crashes in 2000, which was the bid up of the first tech boom, and then the housing collapse, which led to the financial crisis because debts all around the world were unchained, counterparties fell apart. And after that one, we entered the age of quantitative easing, where we just start printing money and spending it everywhere. It really goes through the banking system, and financial people end up getting the benefit of that money because that money doesn't really build anything right away. And there's been a big skim going on in the markets for a very long time now. And that big skim has always been there, but it's been amplified more and more and more, from the 87 crash to the malaise before the tech boom, to the dot-com bust, to the housing boom, to the housing bust, now QE. Quantitative easing has morphed from getting money to the financial sector on the notion that they were going to do something good with it. And there's been some good, certainly, but a huge skim, I call it the big skim, of a fraction of 1% of the people, call it 1% if you want, absorbing 70 some odd percent, 80% of all the gains. And I've showed you the chart that shows that the increase in wealth of the 1% of the population is basically the same as the increase in debt in the United States since 1981. At some point, you have to have an aha moment and set aside the I want to chase, I want to chase, I want to chase, FOMO, 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 and say to yourself, is there a corrective mechanism that's going to come and hit this? And if you set aside ideology and you just pay attention to the politics, you realize that there are some very mundane, wonky things that can be done with the air out of the bubble. Like what? Count capital gains as income. This idea that we're going to have a problem with capital formation in the age of QE and activist central banks is either insane, stupid, or a lie. I think I'm being pretty clear about that. There is no shortage of capital in the world. Savings rates have gone up. Why? Because everybody was afraid of the pandemic, and when the government gave us money, a lot of us put it in the bank. I got more money in the bank now than I did a year ago. How can that be? The economy is worse. So we have this big deflationary wave, right? We're going to have less need for widgets over the next 50 years than we did here. Why? Because there's no more baby boomer wave. The millennial wave just makes up a bit of a hole. These are the millennials. And globally, most countries don't have this. Not the big countries anyway. Not in the EU, not in China, not in Japan. Now, the thing I'm saying isn't very heavily data dependent. So you want data, here it is. Japan, I have talked about, if they can't figure out a way to become an island Switzerland, they're in trouble. China is about to rapidly get older and become older than the United States by the next decade. Over 1 billion people, a lot of them old. Old age dependency means that they're not contributing to the economy anymore, not producing, right? I mean, they still spend some money. They're not producers anymore. And on net, they take more out than they put in. And that's really what that means. The United States, because of the millennials, levels off a bit. It will start to drift up after the middle of this century, but what do we care? This is the world getting older across the board. So that means that many emerging markets are already getting older. India is one of the bright spots, but even they're getting older. If you take a look at where this is going to be in 2050, where the United States was 20, 30 years ago, 40 years ago, you go, India's in pretty good shape. Which is why one of our recent investments is India, Indian linked, and there's a few more that I think are on the board. And again, it's not just the big developed economies that are getting older. It's pretty much everywhere except Africa, and a little bit Australia, New Zealand. I was at an investor conference about 10 years ago. It was one of John Malden's earlier ones. I got to go for free somehow. I don't remember how it happened. Got to meet T. Boone Pickens, met John Malden. I got to meet the team from GavCal, big research firm. And John Malden was calling what was about to go on for decades the muddle through economy. But basically, we didn't have the demographically driven growth, combination of more people, and also hundreds of millions and billions of people being pulled out of poverty, which largely started in the early 70s when Nixon brought China more into the world economy, and we cut the petrodollar deal. Those two things helped move over 1 billion people out of poverty. So when people complain about all the United States intervention, colonialism, you know what? As I've said over and over again, we make lots of mistakes, but in general, we're one of the biggest forces for good, other than God, that the planet has ever seen. And I'm not so sure that I would pin my hopes on God. Because as a Catholic, I think he gives us free will. So he's sitting up there with a bowl of popcorn, as far as I can tell, thinking to himself, how is this going to turn out? I coined the phrase on Market Watch, slow growth forever, about 3 or 4 months before I ever read the term muddle through. So we're basically on the same page here. Demographics from population growth, more babies than people dying, isn't happening anymore. Basically, we're barely replacing, in the developed world, we're barely replacing the people that are dying. Barely. In some countries, that's underwater. Recent story in the Los Angeles Times showed that the birth rate in America dropped 4% last year. Now, I think it might pop back up this year, but we'll see. I'm not sure if people liked or disliked their spouses more by the end of last year. But I'm seeing some babies among the younger people, so we'll see. Why is this also important? Because in the middle of the last decade, what we were spending to pull ourselves out of the financial crisis, which was really triggered by the downturn in demographic-driven growth, became pretty tenuous. We were no longer getting anything on net from what we were spending. Why? Because most of it was not going into the economy. So much of this money has gone into the big skim on the financial side that it hasn't been used the way the capital creation is supposed to be used, which is to build something, to do something productive with the money. We are now at a point where we've created digital monopoly money and we're gambling with it. Why? Because there is so many people out there with such distorted views of how the financial and economic systems work that the crowd just runs in one direction with their chant of the day, pounding the table, and saying to themselves, doggy coin might be the future of currency. Because cryptocurrency might be the way that we trade everything in the future. And there's actually an element of truth to that, which I've talked about with you, which has to do with Cryptodollar. Coming back to this, how sustainable is it that we spend more money than what we get back in goods and services? I would like to give every one of you $20 today. Make sure you give me 50 back. Do you like that trade? That's what's been going on. And when we did the tax cuts on the super wealthy under President Trump, it went through the roof. Then it went through the roof more with the pandemic. I'm telling you right now that the most sensible thing to do is make the capital gains tax income tax. No matter how you make your money, same tax rate. If we did that, I don't think we have to raise any tax rates. And can we put an exemption in there for a house? Sure. Can we put an exemption in there for small real estate developers? Because we need that. Sure. You can tinker around the edges. But for the hedge fund manager or the Wall Street guy, or even the small guys like me, who once in a while can flip $1 million a year, if I made $1 million in capital gains trading the stock market, why shouldn't that be considered my income? Not going back in time, just starting from now. There's not really a way to reclaim what we screwed up in the last 40 years. Elizabeth Warren talks about a wealth tax, and you just know that's never going to pass. There's actually some sense to it, but how do you determine who is a creator and who is a skimmer? It's just too hard. One of the things I learned in constitutional law class was, look, there's a lot of good laws out there, but how do you enforce them? If you can't enforce something, there's no point to it. Capital gains would be easy. And that's what's coming. I'm talking about it because it's going to impact you a little bit. Not much, but a little bit. Where it will impact you is some of these high-flying stocks. Some of these stocks on the weekly chart with relative strength indexes that are through the roof. The list keeps going and going, doesn't it? This is basically every stock on a U.S. exchange, and you are literally looking at all the stocks that are overbought. It's a long scroll. I could keep going. There's a lot of stocks right around 70. So if we take a look at the S&P 500, what we can do is see this period here in 2015-16, which I was telling you over a year ago, seems to be the baseline, seems to be the normal. This is where the trend should have come out of. This line here really is probably, in a world without a massive amount of quantitative easing and near zero interest rates and zero interest rates, probably about where the stock market should be. About 250 on SPY, 2,500 on the S&P 500. And when you consider EV to EBITDA and forward-looking price to earnings ratios and any other nice ratio that you like, fair value on the stock market is somewhere in the 2000s on the S&P 500. And yet we sit a little over 4,000. So if you truly are a value investor, if you think that you care about fundamentals, and you might or you might not, technical traders don't care, you should ask yourself, if fair value is somewhere in the 2000s and the trend line that existed before everything that's gone on in the last 4.5 years is down here in the 2000s, do you think there's a chance we get to the 2000s? Will it be 2000 or 2900? I don't know. But I used an ellipse to figure out where some of the key points were on the top and the bottom of this range. And you see that the range has expanded. That's not good. That's not a good technical indicator. Theoretically, in a world devoid of the manipulation that we see on the financial side from the Federal Reserve, this extreme on the high side would be reflected, like in a mirror, to the extreme on the low side. I don't think they'll let it get to that, but I don't think getting to this trend line is out of the question. I don't think it's likely, but I don't think it's out of the question. This rebound, this V-shaped rebound in the stock market, which hasn't yet manifested in the economy, we'll see that in just a second, indicates to me that the Federal Reserve continuing to buy all this money, throw it into the economy, really into the financial system, it doesn't get to the economy is the point. One of the senior people at BlackRock was on Bloomberg this morning, basically said the same thing. He said, look, we have structural issues in the economy. Mohamed El-Arian synthesized it for him. So if you can go and watch that interview from around 8 o'clock this morning with Mohamed El-Arian and the BlackRock guy, the idea is that we have structural problems that can't just be papered over with more money. More capital, more capital, more capital is not going to solve the problem if we just continue to allow it to be a big skim in the financial system. This, and this don't make sense. Part of it does. Where the market fell to on the pandemic, all it did is drive it to where it belonged. This isn't even big. This isn't even huge oversold or undervalued. Now, it's oversold on the chart because it came straight down so fast. But it really just basically got back to fair value, which it almost did over here too in 2018. So without the QE cocaine, this is where you should expect to be, down in here. Now, are we going to not have QE cocaine? No, we're going to have QE cocaine. You're going to get your cocaine, but you're not going to get as much. Probably starting next year, but maybe this year. We'll see. And I think that the capital gains change, which is coming, it's just a matter of how big of an exemption they put in. I don't think they should put in any, not a dollar figure anyway, but they're talking at $1 million, so fine. Any capital gains over $1 million just counts as income. That's close, whatever. Hits the right one, it hits the 1%. That's where it belongs. Let's all the small guys grinding out 6 figures, flipping 4 houses a year, or running a small business or selling their small business, right? And there's an easy way to solve for that too. If you've been running a small business for the last 20 or 30 years, and you decide to sell it so you can retire, and you get $10 million, they're probably going to let you do an income average. They've had that before, 5 years. Spread out the gains, structure it how you want, pay the taxes over time. There's always something for that. We're not going to bury people. They haven't in the past, they won't do it in the future. To not expect the S&P 500 to get somewhere in this circle in the next 3 or 4 years is probably unrealistic. Will it get all the way down here? Probably not, because of the QE. Somewhere in here. So you're looking at about 15% drop, 15, 16, 17% drop to as much as 40. And if I had to peg it, it'd be right where I wrote the words correction range. It has nothing to do with fair value. Jeremy Grantham pointed out a couple of years ago that maybe we're just going to trade at a higher representation of fair value for a very long time. And that could happen if interest rates stay low. Well, why would interest rates stay low? Well, I'm just going to put this in here so I can rip on her. This is Michelle Bowman, who is a Federal Reserve governor out of Kansas, community banking representative, and she's a moron. You go back and read the things she said, she's been in there, you just have to shake your head and go, she hasn't been right about anything. She's a micro person in a macro world, and she's not even that good at the micro. She'll be out soon. She'll be out next year. So U.S. job growth disappointed. Why did it disappoint? There's an answer. Unemployment rate stayed about the same because some people entered the labor force, but not nearly as many. They projected 1 million new jobs. They got 277,000. Why is that? Well, first of all, and people underestimate this all the time, I don't, because I think it's one of the biggest factors when you calculate employment and the size of the economy and what the growth rates are going to be, is that with the semiconductor shortage, the car industry has slowed down. the car industry, when it slows down, it's not just the people employed by the car companies, it's everybody in the downline parts makers, service providers. So all these people who you thought were going to get hired by the auto industry aren't. In fact, many got laid off. And then you have the service side, which hasn't taken off yet. And this headline by Barron's just screams of their tilt, their supply side tilt. There isn't really a labor shortage. There's not. But Montana and South Carolina are going to get rid of unemployment benefits because, hey, they want to drive people back to work. Here's what this guy thinks. Unemployment myth is very simple. Millions of people are refusing to be serfs on a $300 a week minimum wage. So if you want your serfs back, take away unemployment benefits, Montana, South Carolina. I think what we need to realize is that the imbalances in the economy have an impact. And I would think of a lot of people not going back to work, just continuing to collect the unemployment as kind of being on strike. Their way of saying, why should I go work a shit-ass job, 10 or 12 bucks an hour, and I can get that on unemployment and hang out with my kids and enjoy the summer? Do you really blame them? And what impact will that have for us as investors? If you can't see the writing on the wall that wages at the lower end are going to go up, whether it's through higher minimum wage, which I think is coming later this year. I don't think we're going to get 15. I think we're going to get 10 or 12 with some escalators over time. Manchin already said 12 is acceptable to him. So you're going to see the minimum wage probably jump to 10 this year by the end of the year, and then 12 in a year or two, with some sort of long-term road to 15. I don't think it's going to be fast. It'll probably take the rest of the decade. But anybody who runs against that in the future is in big trouble. So if capital gains rates are going to go up, if wages at the lower end are going to go up, what does that mean for us? It probably means that there's some reversion of the mean coming. I don't think it'll be onerous because we know that fair value is in here, even at low interest rates, coming back into this circle somewhere, and maybe it stops, right? Maybe that was resistance. Maybe now it becomes support. Maybe we'll only get down to 350, 360 on SPY. We'll see. Let's talk about Elon Musk. Remember, after CES last year, those of you who were with me then, I got back from the Consumer Electronics Show and actually did one broadcast from there. I said, you're not going to see fully autonomous vehicles this decade. And what have I heard for the last year plus from Elon Musk? He's been doing a snow job, and I've known he's been doing a snow job. Tesla has been telling the regulators they wouldn't have full self-driving cars for a while. So they tell the public one thing, they call it autopilot, which they should get sued for with that. Anybody who dies driving on autopilot, their family should sue them for $1 billion. That's a misleading name. And why we let them get away with it, I don't know. You can worship Elon Musk all you want for helping move the world, but he's a prick. Ask his ex-wife. And he's a liar. And he's very full of himself. And that's going to be the reason he is going to lose over half of his net worth in the next decade. And you heard it here first. He's going to lose half of his net worth, maybe more. There are too many things stacked against him at this point. From competition from the car industry. I was at the auto show yesterday, and I'm telling you, they're coming for him. And weirdly, the Subaru was the best car I saw. Maybe because the Volvo guys weren't there. The cars were sitting there, but they weren't there. And Ford, Subaru, and Volvo are the three smart ones with the entertainment systems, by the way, with the screens, the monitors on the front. They have them vertical instead of horizontal. So smart. Easier to use, easier to look at. All these companies that have put a computer screen on the dashboard versus an iPad turned sideways are wrong. Satin 30 cars yesterday. Tesla wasn't there. Why? Because they don't do things like that. They're too cool. It's all online. You can barely go and test drive a Tesla because they close so many places. In Milwaukee, I've told you, I can't test drive a Tesla. Why? Because the Chicago outfit that runs the dealership, and it's a crap dealership in an industrial park. They have like 7 Teslas there, and they're supposed to remote unlock them for you. They don't pay attention to their own calendar. So they've been telling the regulators something and the public something else. One of the engineers at Tesla even said, not a chance. I'm just telling you this right now. We'll be lucky to get level 4 driving this decade. We're barely at level 2 right now. Barely. You're going to have really good driver assist. If you try to close your eyes and take a nap in these cars, you might as well just roll dice. Because if you roll boxcars, you're dead. That actually happens once in a while. You roll dice enough times, you'll get 2 6s. So this guy's lying about this. What else is he full of shit about? Well, said Dogecoin might be the future of cryptocurrencies, but invest carefully. He thinks if you want to sort of, speculate and kind of like, I don't know, maybe have some fun. I mean, it's like there's a good chance that crypto is the future of currency on Earth. Well, he's got that right. And what's it going to be? It's going to be the Cryptodollar. Bitcoin, Dogecoin, Ethereum, all of them. Toast. So if you're in cryptocurrencies right now, and you might have been, because I was telling everybody buy Bitcoin right before Labor Day last year, June, July, and August, in about 10 videos. Take your profits, dial it all the way back to maybe half of your original investment, maybe a third, just in case I'm wrong. It's happened before. Ask my ex-wife. Ask my next one. You're going to see cryptocurrencies get blown up because they also are manipulated markets. So whether it's Tesla actually being unprofitable without the carbon credits that they've been selling to Stellantis, who just said they're not going to buy them anymore, or the competition for Tesla, or the fact that Tesla has a bunch of money in Bitcoin. Vet clinic took the doggies in yesterday. They didn't let me pay in Dogecoin. I had to use a credit card. You take a look at this stuff and you say, okay, what's coming down? What in here is coming down? You know why S&P didn't want to put Tesla in the S&P 500? Because they knew. They know what's coming. So Bitcoin, I've said this over and over again, over 80% of the Bitcoin is held in 2% of the accounts. And they trickle it in as they can find greater pools to buy it. This certainly looks like a suspicious chart formation, doesn't it? Looks very toppy. Now, pretty sure it's going to get back into the 30s. If it breaks through this support range right here, it could head down pretty far, towards 20-ish. If it breaks through that, depending on what Janet Yellen has to say, how fast the Cryptodollar gets deployed, which I think is going to start imminently, about a year and a half out. Bottom on Bitcoin might be a lot lower. At one point I said 1,600. I'll stick with that. It goes back down to here, all the way when it started, right there. People say, well, it can't lose 16. It can't go to 1,600. That'd be like a 95, 96, 97% loss. Okay. You can say it can't happen, but you'd be wrong. You can say it won't happen, maybe you're right. Can't and won't are different. And companies that have gone all in on Bitcoin are at huge risk. Tesla is one of them. The reason I think they went into Bitcoin is they're gambling. Musk knows that Ford and Volvo, Subaru, Stellantis, they're all Volkswagen, they're all coming for them. GM. And if you think that there's not going to be as good of cars as Tesla out there, you need to just go sit in a Mustang Mach-E like I did yesterday. I'm telling you, it's the same car. And the charging question has nothing to do with the batteries. It has to do with how you're charging it. So it doesn't matter if you have a Tesla or a Ford. If you have 120 volts at home, you're not getting that car charged overnight. You need 240. And a supercharger is a supercharger. They're at every casino. They're at a lot of places. So you can get 480 in some places. Travel America, which we've talked about, just dying to see this one come back to me. Should have bought a lot more of it when I first talked to you about it in single digits. It's not only moving into hydrogen, but they're going to move into superchargers. They're basically going to tie you there for 20 to 30 minutes while your car charges, and you have nothing to do, buy a burger and a Coke. So there's a lot of things out there, from monetary policy not really being effective at driving the economy because we're not in a short-term downturn. It feels like that because we just had the pandemic, but the reality is we've been fighting this demographic wave for a long time. It's going to last for decades. Countercyclical policy only works against cycles, not against a massive secular trend, which is why the fiscal policy is way more expensive, because it needs to be. We have a lot to get done. We have to create a lot of jobs for low education and mid-education people. And frankly, a lot of MBAs out there are in trouble because of AI. Don't need as many micromanagers and middle managers. So a lot of people who spent money on an MBA thinking, well, I'm just going to manage other people, you're not going to be really needed for that. You better have a technical skill, better have people skills, better have creativity, better have something other than I'm just going to be their boss. The shifts in the economy the rest of this decade, which I started telling you about early last year. Really, I've talked about it for years, but really started pushing it early last year. Then we got interrupted by the pandemic. Are going to be massive. We're going to have cell towers in space. It's going to happen. We're going to have solid state batteries for cars. You're going to see the timeline on EVs and clean energy keep getting pulled forward, not pushed out. And if you buy into the whole, well, if we create this debt, we're in trouble, then you haven't been paying attention the last 40 years. The debts that we create because of monetary policy and tax cuts to the super wealthy are the only ones that haven't worked out. Spending on infrastructure, on education, on healthcare, on daycare, given to the lower middle classes to help them work their way out, that you've almost all benefited from, is what's worked. It's not Republican, it's not Democrat. A lot of these things happen under Tip O'Neill and Newt Gingrich. But as an investor, we need to look at this and say, okay, what does that mean for this stupid chart? It means there will be a correction at some point. Now, does it go way up here first? Does it get all the way to my target of 5,000 on the S&P? I don't know, maybe. Where my target, the S&P 500, I guess I'll have to put it back on here because I started over. What about here? Why? Well, I took the lines out. We take this, going back to the baseline in 2016, which I've talked about a number of times, pull it to here. This takes into account all the distortions of the Fed, right? You have your 1.618 line. I just think we'll get attracted to a shiny number when we get by it. I just think we'll overshoot it. Why? Because we like shiny numbers. So somewhere in here. Now it's going to go like this. That's my guess. Guess it'll be coming here this year sometime. Then we get a rally. Maybe it doesn't happen till here that we get the rally. But if you consider from the end of 2020 to the end of 2024, go from 350-ish to 5,000-ish, that's normal-ish. So what I'm saying is I don't know that we're going to erase all the abnormal, right? But 150 and the 350, about a 42% gain over 4 years, 10% a year, give or take. Now, Rantham and some other people say that we're just going to have an epic collapse and then churn along for a while. I can't say that that's not possible, but I think it's important for you as an investor to really build more safety into your portfolios. And if you want to be long, you better be smart about it. Chasing something with 100 PE, 200 PE, or buying things in secular decline. What happened to the banks today? What if I told you about the banks? People just keep telling me that they're set up for a big rally. They're not. Banks have already come off their last storm, made everything back. There's no upside in banks. Interest rates aren't going up. It's 2 or 3%. That's not a big interest rate. Stop having recency bias. Banks don't make that much on 2 and 3% interest rates. They need interest rates at 5, 6, 7, 8, 9. We may not see those interest rates again in our lifetime because deflation is the real boogeyman. Policy is just there to offset it, create the illusion of inflation, to devalue debt. And when the shift from monetary to fiscal policy occurs, and it's going to start this year, markets are going to respect that. They're going to do what they always do. Say, oh, they're taking away the punch bowl. You'll hear it. Watch CNBC. Once they start saying it, they'll be besides themselves. They'll just say punch bowl, punch bowl, punch bowl. It'll be like they're on drugs. The economy's going to get better. The stock market already reflects that, is the point. And as we change how we handle monetary policy, which is coming, right? Yellen just said it the other day. Then she backtracked. You think it came out of her mouth on accident? Do you really? Monetary policy is going to change. Capital gains rates are going to go up. Money's going to go into the real economy, not the financial casino. As a poker player, I love that. You know why? Because that means a lot of regular people are going to have some extra money to spend in Vegas. And all these people who think that they're superstar traders. I had one guy tell me recently, millennial, told me that he's a chartist. It's like, really? What indicators do you use? We had a little talk. Oh, it's quant stuff. Oh, I was recruited by hedge funds and headhunters out east to be a quant 15 years ago. I get it. Are you using Python or something else? I use Python. Oh, okay. Tell me about your indicators. How do you think about things? He didn't have a clue. You know how he made money? Told you this story before. My brother works at a big firm now, and I used to call these people bull market managers. As long as the market went up, didn't matter what they were doing, as long as they bought. Buy the dip, buy the dip, buy the dip. And it's worked for a year now. Therefore, they think that they are the smartest chartists and traders out there. And they try to suck people in who think, I gotta buy, it's going up. Again, there's different ways to invest. If you care about valuation and fundamentals, there aren't a lot of good options out there right now. Not at these prices. If you think about it like a business person, would you invest in these companies at these prices? Got a condo for sale in our complex that's not fixed up. And they want the same price as a different condo, same size. They had a $30,000 renovation. They basically want the $30,000 for free. And they can't get an offer. Because at some point, people start to say, enough is enough. I don't know exactly how close we are, but here's the chart that you need to remember. It's this relative strength index on the weekly. What happens every time it gets up here? You get a big pullback. Weekly overbought, get a correction. Weekly overbought, get a correction. Weekly overbought, get a correction. Weekly overbought, we're going to get a correction. Doesn't mean it can't go up a little higher, but you need to be really careful about what you own. Somebody asked me about ARK again today. Somebody had a really stupid article on Seeking Alpha. When it was up here, I had these boxes down here. And I never get to here. It's 30% drop. Well, it's happened. And I actually think it's going to go under 100 soon. I think that 80 something is probably where it gets to. Doesn't mean it can't get to 60 something. It certainly can. 30 to 50% drops are not uncommon. This company, it's called Apple. Apple has had 5 30 to 50% drops in the last 20 some odd years. It happens. And this might be the best company in the history of companies. So maybe the best company in the history of companies can have 30 to 50% drops every so often. once or twice a decade. Why can't an index with pushing 200 companies that don't make money and have high debt, why can't that drop 30 to 50%? And lately, the answer has been the Fed. And we know that Janet Yellen believes, right? She's at the Treasury now. She's going to pick out the next Fed governor. She might even be the next. She might go back to the Fed, to be honest with you. She believes that high asset prices are good for the middle class because of their retirement plans. But if you have high unemployment, those people don't get anything in their retirement plans. So policy is going to move a little bit away from QE, not all the way. I don't know that we'll have zero QE ever, not until the central bank, not until the Federal Reserve gets bailed out, and they will. Federal Reserve is going to get bailed out eventually, along with the retirement system. Why? Again, demographics. There is no other solution. We will never, ever grow fast enough to pay for everything that's accumulated in debt. We can get to the point of not generating new debt. Will we? I don't know. We could, if we're smart. We stop giving charlatans like Elon Musk tax breaks. Again, you like him all you want for helping change the world, but he hasn't made a profit in cars. And ultimately, it is a car company and a lot of competition. And he had to sell a Bitcoin profit to make his quarter look good. Somebody asked, isn't every market manipulated? Well, I guess to a degree, but the whole point of markets is that they become efficient when information is good and the rules are fair. And when there's no cornering of the market. Most markets can't get cornered. We have more supply of almost everything than we need. Handful of rare earth metals, which is why I'm in those, right? Not much gold out there in the planet. But energy is getting cheaper and cheaper and cheaper because, hey, there's a fusion power plant in the sky. And we're figuring out how to use it. We got more food than we know what to do with, which is weird that we have hungry people. Well, we just won't give them the food. You know, we ship the food to a country that needs the food. Some guy with a gun keeps it. There's no shortage of capital on the planet. There's no shortage of goods and services. What there is magnificent hoarding at the top. Not just the United States, but around the world. And it's actually worse in China. Commies. So the commies can rip on capitalists all they want, but they do everything more extremely bad. And there is no efficiency because there is no choice. Another reason not to invest in commie stocks. You don't know when they're going to change the rules or just take it. I've lived through that once. I avoided this last one. So I know that was a big brain dump today, but it is all tied together. That article that I wrote yesterday, a day ahead of the employment report, because I knew there was going to be a miss. Now, I didn't think it was going to be that big of a miss. But you have never, ever had great employment numbers when the auto industry is doing poorly. Right now, the auto industry is doing poorly. Why? It's not even their fault. And ultimately, during this malaise in the auto industry, because they can't turn out the cars because of the semiconductors, a lot of companies are catching up to Tesla. So all these things work together. And I'm just telling you, Volvo, Ford, Subaru, Volkswagen, BMW, Toyota, they all have really good cars, even GM. And just a heads up, you know, I talk about real estate here once in a while. I'm going to talk about cars right now. If you have to get a new car right now for some reason, like we do, think about a lease. And normally I don't say that, but the change in technology that's going to occur between now and the next 3, 4, 5 years, pretty huge. So you could buy one more gasoline car or maybe a hybrid. Tell you what, that Toyota Venza was awesome. And then the Lexus versions for a couple extra bucks are pretty nice too. And Volvo, and Volkswagen. Of the gasoline cars, I gotta tell you, that Subaru Outback was pretty awesome. I was shocked we might end up leasing it. I hate to get a pure gasoline car, but the mileage is so high that's not much different than a hybrid. And the EVs, they're okay. They're okay. They're not quite there yet. But if you got the extra 10 grand, 20 grand, I get it. And I'm not worrying of a big market correction. I'm just telling you what the reality is, right? And you always have to look at the correlation of the stocks that you own. Does your stock care about what the market is going to do? Doesn't matter. What is the correlation? There's about 50 stocks that made this happen. Those are the 50 that are in trouble. I have focused today on Tesla. Tesla loses 50%. It's such a big component now that it becomes a big part of the correction. The ARC stocks are already turning over. Clean energy stocks are already, well corrected. So if this market is going to get up here 4 years, what I'm telling you is pick better freaking companies to invest in. Pick companies that can be 10 baggers if you're looking for growth. You pick companies that can triple with a dividend if you're looking for dividends. It can't be much more straightforward than that. There's 200 stocks in the S&P 500 that suck. There's 200 more stocks in the S&P 500 that'll never do better than average. There's some two-digit number of stocks in the S&P 500 that are worth owning. Most of those are in QQQ. Hence why we invest in QQQ and not the S&P 500. And will Apple get down under 100 again? I don't know. I sure as heck want Apple and Google and Microsoft more than I want JP Morgan, Goldman Sachs, and Morgan Stanley, and Wells Fargo. Asset light, less dependent on the economy. And I'll tell you this, all the REIT investors out there, you got a comeuppance coming, because there is so much massive spending that has to go on in real estate that you just got a ton of REITs that are going to get killed. And the shifts in shopping and everything else. The capital cycle in real estate is overlapping rather than creating a period where you just collect rents. And there's not much in between there. The home builders have spiked. I told you 2 years ago to look at those. I've been told by the chief investment officer of a big fund, Kirk, I read your stuff and you are like 2 years ahead on everything. So I've moved to these technical indicators to help me for the on-time trading. The things I'm investing in today, I was talking about 2 years ago, 3 years ago, 4 years ago. So when I talk about cell towers in the sky, and I say I don't want to bet against the scientists, what I'm telling you is put a couple bucks in the cell towers in the sky. And finally, my very best investment idea that I pounded the table on for the last month, told you to buy gold stocks. You want an easy 20%, 30% gain in the next year or two, buy GDX. And if Yellen does what I think she's going to do with cryptocurrency and the crypto dollar and regulating Bitcoin and everything else, doggy coin and the rest, it could be a double. You need to have something between 10 and 20% of your portfolio in these gold stocks. You pick if you want to be closer to 10 or 20, depending on you. A bunch of you should have cash secured puts expiring on this. So this is easy. You don't have to own a lot of things. This one's easy. If you get a little down tick, right? If you get a second chance at 31, 32, and you better back up the truck. These companies are making money hand over fist. You see Barrick's report? Where did all of Barrick's excess money come from this quarter? What metal? Copper. So I think it's important that people define who you are as an investor. And I will tell you, if you're trading short term, you better be really good at it, because you're working against hedge funds, supercomputers, and liars, cheaters, and thieves that work behind a curtain, and the Reddit army now. If you think you're just going to look at charts and say, oh, this is a nice pattern, you got another thing coming. Because the millennials, as I discussed last October, are learning how to bet the other direction. And if you think that they can't be the marginal downside, just like they were the marginal upside, then you haven't been paying attention. Because the minute the shift in liquidity happens, the minute that it starts going through the fiscal side, which goes through companies that build things and do things, versus the monetary policy to the financial system, which goes into the stock market casino, it changes. The bet goes the other way. Think of it like a roulette wheel that has a cheat button. There's a shift coming. I don't know how fast. I think this year. And if you're relying on basic technical indicators for day trading or swing trading, you better be a superstar. Because most of you are chum in a Shark Tank. It's just the way it is. And I'm not insulting anybody, because if you know you're a great trader, then you know you're a great trader. And you're thinking to yourself, stop telling these other people not to trade, because that's whose money I take. It's just like in poker, when I don't tell people, I will tell people how I beat them, but I won't insult them. Why? Because I want them to keep playing. I want the bad players at the table. I love that. But if you don't know who the sucker is at the table, right, it's you. So be careful out there. Broad market is overbought. This is not a short-term signal. This one's based on a monthly chart that just popped up. So the monthly chart is overbought. I hadn't even looked at that. The weekly chart is overbought. The daily is almost overbought. That combination, daily, weekly, and monthly, all overbought at the same time, is really dangerous. But if you haven't been minding your asset allocation, you need to do it. All right, let's call it a day. That went too long. Take care, everybody.